Every year, there is a headline that you will read in financial papers, which is global debt reaches a new record. And we've grown accustomed to the idea that it doesn't matter. However, it does. And there is a very, very significant problem that is brewing, and that fits nicely with what we have just heard from Mr. Taleb, which is the problem of tail risk. We have grown to be accustomed to the idea that central banks and government deficit spending are the lenders of first resort instead of the lenders of last resort. That is exceedingly dangerous. And that is very dangerous because it has created two generations of traders in the market that have only seen expansionary monetary policies. So when you talk every day in the market about what is going on these days about global debt and market valuations and what is going on in the US or Europe, etc., we tend to ascribe a catalyst to the things that happen, and they're always political. Now, in the UK, we saw that Prime Minister Liz Truss was blamed for the rise in UK government bond yields. It had absolutely nothing to do with her. At the same time, we saw how Japanese bond yields were also soaring and French bond yields were soaring as well. And nobody blamed the Japanese government for spending too much, none the French government for spending way too much. However, what we have is one of the most dangerous situations in a free market economy that one can find, which is an entire market in which participants are accustomed to the idea that bad is good. If a government spends too much, if deficit spending soars, if debt goes through the roof, it is excellent. Why? Because it means further money printing. It means that the central bank is going to inject liquidity, which is the subterfuge of printing money, which is basically the evidence of an increase in the problems that Mr. Taleb was mentioning right before, which is the tail risk events. Central banks don't print money. Central banks are only buying the money that has been created by governments. Money is not what governments think it is. Money is debt. And money is not only debt, but is also representing credit of the economy. In fact, it is not even representing the credit of the economy, as you have seen in many crises. Numerous independent or private entities have a much better credit rating than governments themselves. It only represents the ability of the government to exert violence and increase taxes and improve the collection of those taxes. High taxes are not a measure to reduce debt. They are a justification to increase debt. Now, why do markets incentivize government spending, incentivize government deficit spending, incentivize a worsening of the credit indicators of the financial institutions and of the government in particular? Because it means that the central bank is going to conduct easing policies that will ultimately lead to increased valuations of risky assets. And that is what leads to boom and bust cycles. We are, it's true, in an environment in which financial crises are very frequent, but they're also less abrupt. And a lot of people don't even remember them. In fact, if we asked anybody here in the audience how many financial crises they have lived, they will probably answer 2. But it's probably 7 or 10, and if it's Mexico, 11. Why? Because we are getting used to the idea of inflation having the only option for governments to continue to exist. But not because we have we don't have other options, but because we think it's easier. On the one hand, a lot of people think that inflation is increasing prices. Inflation is not the increase in prices. Inflation is the destruction of the purchasing power of the currency. And inflation is a de facto default. It's an implicit default that happens very, very slowly. When central banks talk about the concept of stability of prices, they are talking about an annualized inflation of 2%. That is insane. That is not stability. If I gain £2 every year, I'm not getting any thinner. That is inflation. Why do we have a quid pro quo in which we accept a 2% level of inflation measured by CPI in order to see further credit and cheaper credit? That is fine as long as the economy is growing more than the accumulation of debt. That is fine as long as productive debt is generating higher productivity, more investment, and more jobs. In the past 4 years, the United States economic growth, allegedly robust, as we have heard over and over and over again, has been the worst, excluding the accumulation of debt, since the 1930s. The worst. In 2024, the United States GDP growth, real GDP growth, including a bloated government spending that increased by 10%, was lower, the entire GDP growth increase, than the increase of the deficit. Then, what we see is what is happening right now, is that markets are reacting very aggressively to the stimulus that come from central banks. You may have heard that markets are in absolute turmoil because of tariffs and absolute turmoil because of the new administration in the United States. Allow me to disagree. The only reason why markets are in turmoil is because in 2024, all central banks told the world that we were in a massively disinflationary process, that disinflation was on track, that we were going to reach the levels of inflation that they had in their targets, and they started in June 2024 panicking by delaying the reduction of the balance sheet, and they continued in September 2024 by cutting rates when there was absolutely no evidence of disinflationary processes. In fact, when there was an absolute evidence of the opposite, that inflation was actually accelerating. Why did they do that? To disguise government imbalances. So what's happened in January is that suddenly the Federal Reserve went from incredibly optimistic about inflation and incredibly optimistic about the outcome of both growth, inflation, and jobs in the economy to the opposite. And it wasn't because of any other factor than more money going to a relatively scarce number of assets. In reality, the reason why the Fed panicked on the way down with interest rates, and the reason why it continued to panic then in December, is because central banks are monetary authorities that don't pay any attention to monetary aggregates. And that is one of the main reasons why we go from boom cycles to bust cycles, because they look at everything and anything except the accumulation of debt and the excessive amount of money in the system. In the last 6 months of 2024, money supply growth was a 27-month high in the United States. How could anyone in their right mind think that there was going to be a process of disinflation? A lot of people think that inflation is going to come down because they're going to gather together and sing John Lennon songs. Inflation only comes down if government spending comes down, and with government spending, money supply growth, and with money supply growth, obviously, money velocity, and with it, inflation. Tariffs don't cause inflation. There's absolutely no evidence of any element of inflationary pressures coming from the concept of supply chain disruptions. It's a stupidity. If something is way too expensive because there's a war, the rest of prices don't go up. The only way in which the rest of prices go up, there is a war, or if there is a supply chain disruption and transport is too high or oil is too high, is if the quantity of money is much larger than the real production in the economy. So, what we are living right now? What we are living right now is not a new paradigm. We're not seeing something radical happening in the economy. What we are seeing simply is the process of adjustment of people's expectations about what is stability of price. This market volatility that we're seeing right now is not people being nervous about political events. People should have been exceedingly nervous about reading the budget that the Biden administration published in 2023, in which the average deficit for the forthcoming decade was going to be $16 trillion. Nobody said anything. In fact, markets soared logically. More inflation, i.e. more asset price valuations. But that is a very dangerous process. Why? Because what we are grown to think of is that market reactions are a symptom of the negative policies that are implemented by governments, when it's actually the opposite. Markets are reacting to the good policies, i.e. cutting spending, reducing taxes, improving the economy, etc. They're reacting negatively to that. And when you hear the German government is going to spend 100 billion euro on climate change, the stock market in Germany soars. Logical. More money going to lower number of assets or scarce assets. But that is very dangerous. Why? Because in 2008, there were at least 25 different papers published saying that monetary aggregates don't matter, and that the inflation process had absolutely nothing to do with monetary aggregates, and that we had found the golden magic wand that would allow us to continue to grow by conducting constant and perpetual quantitative easing programs. Quantitative easing programs are nothing but doing what Mr. Taleb has just mentioned a few minutes ago, which is to disguise tail risk. Quantitative easing doesn't eliminate risk; it just disguises it. And the thing that makes risk happen is that risk builds very, very slowly, and people get accustomed to it. People get used to the fact that technological companies trade at 15 times earnings, 20 times earnings, 30 times earnings, no problem. And then inflation, which is a de facto default, is what is showing us that we're wrong. And we are being adjusted in real time to getting used to the fact that stable prices are not 2%, it's 3%, which is getting even worse in an environment in which what is going on globally is an environment in which citizens are not only feeling poorer, rightly, but also in which the measure of that inflation, CPI, is hugely manipulated to show a much lower element of inflationary pressures than reality. Now, then you're doing it. 2 minutes, great. I thought there was going to be a trap that opens when you finish, but it doesn't. Great. In my last 2 minutes, I'm going to tell you what is going to happen in the next few years. Number one, every time that there is a market disruption, somebody will tell you yet again that the solution is more central planning, more government spending, more deficit spending, and that the reason why markets are falling is because of supply side measures. And if you implement supply side measures, cut spending, and reduce taxes, that is bad for markets, which means it's bad for the economy. Be very careful about market participants, because they're not the same as when I started in the business. When I started in the business, market participants were there to highlight the risks that we're building in the economy. Right now, we have market participants which go on any type of media to justify any imbalance. I just read this morning that this invented Realm plan from the European Union, yeah, 800 billion euro. Huh? Everybody's talking about the 800 billion we have from the European Union. Fantastic, fantastic. Who's going to pay for that? I haven't read that anywhere. No? Who's going to pay for that? You know who? We're going to pay for it. We're going to be impoverished, and the only way out for fiat currencies and for governments that continue to increase those imbalances is to impose the utilization of the currency, therefore the implementation of central bank digital currencies. Therefore, what we are seeing right now is that less money supply is something that people don't like. And what we have seen in the economy is lower money supply because the government of the United States is spending less, which is not a bad thing. So, what is likely to happen in the future is that we're not going to see a de-dollarization, but a re-dollarization. And what is likely to happen in the future is that we will get used to stable prices at 3 to 4% CPI, which means we will be poorer. You need to start preparing for that yesterday. Thank you very much.